Hey there, Prof. Aram here, and in this video we're going to look at some of the risks that are involved in investing in corporate bonds. So let's get to this. The first and one of the most important risks involved in investing in bonds is the interest rate risk. And it involves two components. One is the price risk and the other one is the reinvestment risk. So the first one, the price risk, is a change in the price due to changes in interest rates. For example, if interest rates go up, you already know that the price of the bond will fall. So this is a risk for an investor in the bond market. We know that in a bond, you also receive income. You also receive coupons, cash flows over the life of the bond. And most investors don't need the cash immediately. So they are going to reinvest this cash in bonds of similar risk or investments of similar risk. So the reinvestment risk is the uncertainty concerning rates at which cash flows can be reinvested. In this case, if rates go up, your reinvestment risk is lower because in the future, you're going to reinvest the cash flows or coupons at a higher rate. But if the opposite happens and rates go down, prices will increase. So this is actually good for in terms of the price risk, but that means in the future, when you receive these coupons, you're going to reinvest them at a lower rate. So let's look at an example for the price risk. We have two bonds here. The green one is a 30-year bond, and then the blue one is a 1-year bond. Both of them have 10% coupon rate, so that means that at 10% yield to maturity or interest rate, both of them are priced at par. If we increase the rates from 10 to 20%, in other words, double the rates, we see that the 1-year bond is not affected that much. 1-year bond drops in value about $80 from $1,000 to $916.67. But the 30-year bond witnessed a significant drop in price. Almost half the price is wiped out because the interest rates has increased. When interest rates go up, the price should fall. The opposite is true as well. When rates go from 10% to 5%, the price should increase, but the 1-year bond price goes up slightly, only $47, but the increase in the price of 30-year bond is significantly higher, $1,768. So a gain of $768 for that price drop in the price. So the conclusion is, if you have a longer term to maturity bond, that longer term to maturity bond has a higher risk, higher price risk, higher interest rate risk compared to short-term bonds. Another one is for the coupons, meaning that if you have two identical bonds, one of them pays higher coupon rate, the other one pays low coupon rate. Usually the low coupon rate bond is riskier because it provides fewer cash flows, lower cash flows compared to high coupon bond. Since in the high coupon bond you receive more cash flows, it is inherently less risky compared to a low coupon bond. The opposite is true for the reinvestment risk. The short-term bonds have more reinvestment risk than long-term bonds, and high coupon bonds have more reinvestment risk than low coupon bonds. So that's the interest rate risk. The other one is the credit or default risk. So we're going to add another premium to our return, to our expected rate of return. Usually, US Treasury securities are considered risk-free. And when we call them risk-free, we are basically saying that they don't have the risk of default. They still have interest rate risk, US Treasuries, but they are considered free of default because of the assumption that US government can always increase taxes to pay off its loan, we are considering treasuries risk-free. Any other bond has some kind of default risk, have some level of default risk. And because of that, most of these bonds, corporate bonds and government bonds, are rated by the credit rating agencies. I'm talking about Fitch, Moody's, and Standard & Poor's. These are the main three credit rating agencies that look at different bond issuances and rate them. And the reason for that is that most of the times individual investors don't know what's going on inside the firm or inside the government entity, or they don't have the expertise to analyze the financial information of these entities. So in order to reduce the information asymmetry between the company or issuer entity and the investors, these credit rating agencies come in and try to provide ratings for these issuers. So the higher the rating, the lower the risk of default. For example, if you see a AAA rated bond, that issuer, whether it's a corporation or a government entity, they have the capacity to pay the interest and principal is extremely strong. We call these investment grade bonds. On the other hand, these credit rating agencies, when they give a rating of B or C to a corporation or a government entity, that means that there is a high probability of default in these bonds. These bonds are considered, there's a possibility that they don't have the capacity to pay the interest and principal. And that's why sometimes in the market they call them junk bonds. Or because they are low quality, investors demand a higher rate of return for them. We also call them high yield bonds. So that's for the default risk. Another type of risk is liquidity risk. So we're going to add a third premium here, the liquidity premium. Unlike the stock market, majority of the trading in the, especially the corporate bond market, majority of the trading in the corporate bond market happens in over-the-counter market. Majority of these corporate bonds are not listed in an exchange. So because of that, the trading is very sparse and very slow in the corporate bond market. And because of that, there is a liquidity risk involved, meaning that sometimes you won't be able to sell your bond immediately without the loss of value. So the liquidity risk is very important here. And this is true for the corporate bonds. We're not talking about US Treasuries. US Treasuries, in fact, are some of the most liquid bonds out there. And the reason is the investor pool, meaning that for US Treasuries, the market has both width and depth, meaning that there are millions of investors in the US Treasury market. So there are a lot of players in that market. There are a lot of investors in that market. And the other one is depth, meaning that the size of transactions in the US Treasury market are usually very large. And because of that, since this market has width and depth, the US Treasury market is very, very, very liquid. In fact, you can sell your treasuries within seconds. But that's not necessarily true for corporate bonds. And another type of risk that we are going to look at here is the inflation risk. So inflation is a general rise in the price of goods and services, which causes a decline in the purchasing power. So that's why we're going to add a fourth premium here, which is the inflation premium. Let's talk about this a little bit more. We have two types of return. One of them is the nominal rate of return, nominal rate of interest, which in the case of a bond is the yield to maturity that you see. It's the quoted rate of return or the nominal rate of return on any security. But the real rate of interest is the change in your purchasing power, right? I don't really care how much return I get on paper. What I care about is how much I can buy with my investment at the end of the period. So let's look at an example here. Let's say the inflation over the year is 5%. In the beginning of the year, you set aside $100, and then you're going to receive 115.5 in 1 year. So the yield on this investment for you is going to be 15.5%. So this is your nominal or quoted rate of return. Now, let's look at the price of goods and services, right? So let's say a slice of pizza would cost $5 in the beginning of the period, and given the 5% inflation, it would cost $5.25 at the end of the year. How does this inflation changes your purchasing power? So in the beginning of the year, with your money, you could buy $20 slices of pizza. And at the end of the year, with your investment growing to 115.5, but the price of pizza is $5.25 now, you can only buy 22 slices of pizza. So if you calculate your rate of return in terms of pizzas, so rate of return is ending value divided by beginning value minus 1. So 22 over 10%. So even though on paper you're earning 15.5%, but your purchasing power has only grown, your actual rate of return has grown only 10%. In fact, when you consider inflation, when you consider your purchasing power, your real rate of return is only 10%. That's why always we want to focus on the inflation adjusted rate of return or real rate of return. And that's why we can use this formula, Fisher formula. So the Fisher formula states that 1 plus the nominal rate of return equals 1 plus the real rate times 1 plus the inflation. So I can basically write it this way. 1 plus nominal equals 1 plus real times 1 plus inflation. This gives you the exact number. So your real rate would be 1 plus nominal over 1 plus inflation minus 1. Right? So this gives you the exact real rate of return considering the inflation, and this is the approximation. Let's look at an example here. If you require a 10% real return and we expect the inflation to be 8%, what is the nominal rate of return? So capital R would be 1 plus the real rate times 1 plus the inflation rate minus 1. That gives you 18.8%. So you should be able to earn 18.8% on your investment only to get to receive 10% real rate of return because of that high inflation of 8%. I hope you find this video useful, and thanks for watching.